Hello and welcome to Core Finance. I'm Matt Brown, joined today by Mike Van Dulken, who is Head of Research at Accendo Market, for the first of 3 videos. So thank you very much for coming in today, Mike. We kick off with Brent crude. It's had a bit of a pickup of late. Talk us through, number one, why, and potentially where this can go from here.
So firstly, what we're looking at here is a breakout beyond what we call falling highs resistance, which goes all the way back to the beginning of the year. So it's a major hurdle to overcome, certainly at this kind of later stage of the year, and it opens the door potentially to a return to the highs at the beginning of the year. We've had several OPEC and non-OPEC meetings throughout the year, and the latest chat from the latest meetings has been that the likelihood is of an extension to the production cut agreements. Then we've moved on to not just production cuts, because many have cut production, but now they've been selling what they've had in inventory, which is of no help to anyone. So now they're talking of actually potentially capping some of the exports as well. So the laws of supply and demand, reduce the supply, and to allow them to increase prices. So this has slowly buoyed the prices in from the middle of the summer. Getting above 55 was a key thing of late, and we've seen more interest there. Also in the States, I read over the weekend actually that WTI, which is the US benchmark, had actually seen open interest on futures eclipse that of Brent for the first time in a long time. I can't quite remember the period, and that's based on the number of rigs in the US actually not increasing as quickly, which implies that a lot of the guys interested in shale are already back now, making the most of the higher prices. So long as they don't flood the market, it is supportive of the oil markets for the near term. So the upside might not be huge. I think we're just shy of maybe 5% if we get back to the recent highs. But what's most helpful is it keeps oil in at least a range of, if that's $45 to $60, I think most people will be very happy with that in the near term.
And I mean, trading it as well, we're kind of a long way off the volatility we saw in WTI and Brent going back a few years ago. So do you think that will draw more investors in now because they feel that there isn't that volatility, so there isn't as much risk, or do you think there'll be less investors now looking at oil?
I think oil still has the potential to be volatile at certain moments of the year. So the next OPEC meeting has as much potential in the run up to it, during and afterwards, to see some price movement. It's true that if you zoom out on this chart, it masks the fact that we were at 130. This is actually an incredibly narrow range for oil historically. But if it does lead to trading within that range, down to lows of 45 and up to highs of 60, it could well be that that's actually quite healthy for bringing whoever has the lowest costs in down at the floor, buoying the market back up again, and indeed filtering out those who can't do it at the top. It could offer range trading opportunities for the near term, but so long as it remains within a tightish range, it also offers stability for many corporates to plan. If they know oil's roughly going to be there, in terms of hedging, it makes their lives a lot easier.
Understood. Mike, thanks very much for joining us today.
Thank you.